This is physical damage coverage. So this is going to be coverage for the insured's inventory. So if he is a dealer, this is going to provide loss or damage to the autos that are on his lot. Again, very similar to garage keepers. There's comprehensive coverage, which is going to cover any losses except for the covered auto's collision with another object or the covered auto's overturn. For physical damage, specified causes of loss, it's a little bit more broad. It's fire, lightning, or explosion, theft, windstorm, hail, earthquake, flood, mischief and vandalism, or the sinking, burning, collision, or derailment of any conveyance transporting the covered auto. I will point out, though, you want to make sure that you're checking in with your quote, your carrier that you're going with. Some carriers do have specific exclusions. So just because these coverages are afforded in the ISO coverage form, you're going to want to make sure you check your quote to see if that company has built-in exclusions for, say, flood or earthquake. That can be very, it can vary by carrier to carrier. So again, just be cautious of that and make sure you're checking your quotes to see which of the perils may be excluded. For collision, again, it's very similar to the garage keepers. The covered auto's collision with another object or the covered auto's overturn. As far as physical damage coverage, the exclusions, again, very similar. The first is being nuclear hazard, war, or military action. Any covered auto leased or rented to others unless rented to one of your customers while their auto is left with you for service or repair. Again, I will caution you, depending on your carrier and the quotes that have been offered, that coverage may not be available to you. So it is very important to review your quote to make sure that you're going to have that coverage. It's not always provided for the basically the renting of auto while it's in for care, custody, control. So you want to make sure you're checking that. The next being any covered auto while used in professional or organized racing or demolition contests or stunting activity, or while practicing for such contest or activity. I will also say there that it's going to depend on the company that you're placing your business with. You'll want to make sure that you're checking your exclusions. Some carriers have very wordy exclusions for racing, so you want to make sure that you understand the insured's operations and also the exclusions that are contained within the quotations that you're offering them. The next one is your expected profit, including loss of market value or resale value. So when they are adjusting a physical damage claim, they are only going to consider your investment in the auto. So if you pay $2,000 for this auto and you were expecting to sell it for, say, $3,500, the most we would be paying is the $2,000 because that's the investment in the auto. We wouldn't pay for the expected gain, so that retail value. So that's something to keep in mind. The next exclusion, loss to any covered auto displayed or stored at any location not shown in the declarations page for if the loss occurs more than 45 days after your use of the location begins. So that is important. You want to make sure that you're disclosing all of the locations that the insured is occupying. I know that sometimes autos are stored at temporary locations, and something we're seeing more and more recently is wholesalers, so auto wholesalers selling from dealer to dealer or from dealer to auction type risks, that they're leaving those autos at the auction. So you want to make sure you're being very cautious as far as the language that is contained within your quotes, and taking into consideration also this exclusion, because there might not be coverage for the autos that are stored at the auction. So you'll want to make sure, again, that you're asking the question to your insured where the autos are being stored. And we'll get into a little bit more how you can kind of ask those questions. So I won't go into too much of that here, but just know that exclusion exists. The last one is false pretense. So a lot of the times when we get submissions in the door, we will have losses that are being presented as theft claims. However, they actually are under false pretense. So in the coverage form, it automatically excludes false pretense, which is someone causing you to voluntarily part with the auto by trick or scheme under false pretenses, or you're acquiring of an auto from a seller who did not have the legal title. So, for example, number one, or bullet point number one, I would say how this happens is somebody goes out for a test drive when the auto is unaccompanied. So typically we want to see salespeople accompanying all customers and potential buyers on test drives. If that isn't happening and that customer drives off with the auto and doesn't return it, that's not a theft. That is false pretense. They voluntarily parted with the auto. And so that is excluded in the coverage form. So you want to be mindful of that. There is a buyback that is available, but it is subject to underwriting criteria. And that's why it's really important to get in a garage application, because it's going to ask you the questions that Teresa is going to need to be able to properly underwrite the risk and see if the risk is going to qualify for that buyback coverage. The second one is pretty self-explanatory, so I won't go into too much detail on that bullet point. For physical damage coverage, the limit of insurance, this kind of goes back to what we were talking about before. The most we will pay for loss to any one covered auto is the lesser of the actual cash value of the damaged or stolen property at the time of loss, or the cost of repairing or replacing the damaged or stolen property with the property of like kind and quality. Again, that's saying that we're not going to pay for the expected profit. It's going to be the actual cash value. There will be an adjustment made for depreciation and physical condition when determining the actual cash value in the event of a total loss. So that's something to keep in mind. If a repair or replacement results in a better than like kind or quality, we will not pay for the amount of the betterment. The last point to note on this section is that there is a 100% insured value coinsurance clause for this coverage. So where it's not on the garage keepers, it is still vital to ensure those limits to value for the total exposure. It is built into the coverage form for the dealer's physical damage, so the owned autos. I recently had this loss, and just to kind of give you an idea of how underinsured it was, they had several autos that were damaged in a hailstorm, and the limits were nowhere insured to where they needed to be. At the end of it all, the final payment was only 6% of the actual loss. So just like property, it is very important that you insure this coverage to value. Some carriers' applications will kind of give you some guiding hands as far as how you determine what kind of limit you're going to need. If that application in particular doesn't have it, you can always ask about how many autos do you have on average? How many do you have at max at any one time? What's the average value of any one auto? And then what's the max value of any one auto? When you multiply those out, it'll kind of give you an indication of where they will typically be inventory-wise. Again, this is going to be their acquisition cost values, not the retail values. And two, because of this clause that is in the coverage form, you want to be mindful that you're insuring it for the total exposure. There is no peak period type endorsement. It would be up to you guys to catch that. So like something that comes to mind are when tax returns come out, a lot of people will go and purchase autos during that time. So if you have an insured who increases their inventory during that time, you'll want to make sure that you're increasing your limit if you don't think it's sufficient at that point. I would prefer, in a perfect world, that the limits are insured for the total exposure, the whole annual period. So if not, you're going to want to make sure, again, that you're accounting for those peak periods.